Well, good afternoon, everyone. Thanks for joining us for our new knowledge today, talking about tax planning with, I'll let Kathy introduce our host and our presenter in just a moment, but I wanted to welcome everyone. My name is Sandy Ratliff. I'm with Virginia Community Capital. And of course, as you know, this has been a partnership of VCC and the Chamber and the Washington County Chamber of Commerce and the Virginia Highland Small Business Incubator since 2015, and we promote these and provide these sessions on an ongoing basis. Just a little housekeeping before I turn it over to Kathy Lowe is that in an effort to keep the session flowing and stay within our 1 hour session, we have everyone muted. But if you have questions for our presenter today, please post those either in the Q&A section or in the chat feature, and I'm sure Mike will address those at the end of his presentation. So I'm going to turn it over to Kathy Lowe with the Virginia Highland Small Business Incubator to introduce our presenter today.
We're excited to have our presenter today. Mike Spiegler has been a CPA in Abingdon for more years than I can remember. He is a wonderful community advocate for our organization as well as other organizations in Washington County. And he has always been willing to help us with our new knowledge classes and our business challenge classes. And so today he's going to present 2020 tax changes and tax planning strategies. Now is the time to prevent surprises. So without further ado, my boss and the community's friend, Mike Spiegler.
Kathy, thank you for that kind introduction, and I welcome everybody today. As you said, my name is Mike Spiegler, and I'm a CPA here in Abingdon, Virginia. Actually, in Southwest Virginia and Upper East Tennessee, we have a couple offices, and we are a regional firm focused on serving the tax and accounting needs for businesses and their owners. Today, we're going to talk about a couple of different topics, and I realize that the topic associated with today's presentation is year-end tax planning, and we'll get to that, but I feel like it's important to first discuss some of the various tax changes that have occurred over the last few years that have had a major impact on tax and tax planning. During our discussion today, we're going to touch on topics that include retirement income, business deductions, charitable contributions, and just some general tax planning strategies. Over the last 3 years, there have been three major pieces of tax legislation. Back in 2017, we saw what was called the Tax Cuts and Jobs Act of 2017, which was the most sweeping tax legislation since 1986. It included some nominal reductions in individual tax rates, but had many business tax incentives as well as large corporate tax reductions. In late 2019, we saw the Secures Act, which was focused on tax and retirement plan changes that were enacted to try to induce some long-term retirement savings. And then most recently, in March of this year, we all know about the CARES Act. The CARES Act is the largest fiscal stimulus bill passed in U.S. history. Its provisions include substantial aid provided businesses with a lot of new benefits that weren't there before. And although we won't talk about them much as they're not as relevant for small businesses as they once were, but C corporations saw a major reduction in maximum tax rates from 34% down to 21%. These entities, C corporations, are usually only utilized anymore by companies who need to build and retain large amounts of capital. The largest benefactors of the TCJA were pass-through entities, which include S corporations, partnerships, LLCs, and sole proprietorships. The act included one of the biggest benefits in the act was the 20% deduction for qualified business income. This 20% deduction is based upon what's defined as qualified business income, which very generally speaking is based upon the net business profits at lower income levels. The deduction phases out at higher income levels between $213,000 and $426,600, depending on whether you're single or married. And the computation becomes more complicated as income increases because it takes into account W-2 wages paid and the cost of qualified property into the computation. However, as you can see on this slide here, the tax savings can be substantial. For small businesses, this deduction will be calculated and reported on the owner's 1040. It's important to remember that the deduction is 20%, not the tax savings. The tax savings are based upon the taxpayer's marginal bracket. In this example, this business profits by $80,000, and it also, I just showed an elective contribution to a SEP retirement plan, but it overall, because of the deduction, yielded tax savings of $2,640. Other major tax breaks that came out of the TJCA included depreciation changes. The TJCA provided businesses with increased opportunities to deduct the cost of new and used equipment and real estate. Basically, businesses have the opportunity to expense up to $2.5 million of new and used depreciable property each year. They can use one of two methods, or they can use both methods to maximize their deductions. A deduction for bonus depreciation can be claimed for 100% of the qualified costs of new or used property. This deduction was previously limited to 50% of the cost. This deduction will be phased out over the 4 years from 2023 to 2026 in 20% increments each year. A depreciation deduction is also available under IRS Code Section 179, and it was increased from $510,000 to $1 million. While the bonus depreciation has no limitation other than the cost of the property, the Section 179 deduction is limited to taxable income from the activity. As such, the 179 deduction is only available to the extent that it will zero out income, while the bonus depreciation deduction can create a loss. Any excess of the Section 179 deduction can be carried forward to successive years. So these two separate and distinct deductions provide a great arsenal for current as well as future tax planning because they both have different limitations that can be used as planning opportunities. Another change that the Tax Jobs and Cuts Act provided was the expanded eligibility for small businesses to use the cash basis method of accounting. This change is substantial as it has caused many small business clients to maintain their books on the accrual basis of accounting, which can prove burdensome from the standpoint of compliance in maintaining inventory records. The availability of the cash basis and the opportunity to change methods may provide some initial tax savings to businesses. And we have seen that across our client base and the clients that we have converted from accrual basis to cash basis. There can be a good injection of tax savings, i.e. cash, in the initial year. In addition to these business changes, the Act made changes to individual taxation. It lowered the maximum individual tax rate from 39.6% to 37%. It also increased standard deductions, eliminated dependent exemptions, and increased the child tax credit from $1,000 to $2,000. 2020 brought forth a couple of additional tax law changes. The Secure Act was passed in late 2019, but became effective in 2020. Congress's goal was to implement changes that would spur good long-term growth in retirement benefits and accounts. This act made changes to employer retirement plan rules that provided part-time workers with access to benefits that were previously reserved only for full-time employees. It also made changes to the individual income tax laws. The act changed the age requirement for required minimum distributions from retirement plans from age 70 and a half to age 72 for people turning age 70 and a half after 2019. Thus, younger workers and part-time workers can begin to grow their funds at an earlier point in time. It also changed the rules for inherited IRAs such that the funds must be withdrawn within 10 years as opposed to the former provision for withdrawal over the life expectancy of the beneficiary. There are exceptions, however, for surviving spouses, minor children, and disabled and chronically ill beneficiaries. This change will actually result in a reduction of retirement accounts and was included as part of the revenue-raising part of the law. Another aspect of the change in law was to remove the age limit for being able to make IRA contributions. Formerly, nobody over age 70 and a half could make an IRA contribution. This age limit has now been removed, and this change will allow people who continue to work or own businesses to be able to shelter their income from taxation using IRA or other retirement plan contributions. Under the new law, parents will be able to withdraw up to $5,000 from IRAs without a penalty. Again, that was new parents, i.e. parents who have a baby. Again, this is a tax raiser, but it will help families to fund the costs associated with new children. Congress again addressed tax reform when they considered legislation to submit the economy as a result of this year's COVID-19 pandemic. The CARES Act was signed into law in March of this year, and it was the largest fiscal stimulus bill in U.S. history designed to restart the U.S. economy. The law includes provisions for grants and loans for businesses and individuals. It also contained many acronyms, EIDL, PPP, and PUA being the most widely recognized monikers. As you can see on the slide, EIDL is the Economic Injury Disaster loans. PPP is a Paycheck Protection Plan loans, and PUA is a Pandemic Unemployment Assistance. Individual provisions centered around IRA and IRA provisions were included. Congress recognized that some individuals were going to have to access retirement savings accounts to obtain funds for their living expenses. In order to address individuals directly affected by COVID or who experience a decrease in work as a result of the virus, they removed the 10% penalty on what they now call CRDs, or coronavirus-related distributions. They also removed the 20% mandatory federal income tax withholding and gave us the ability to pay tax on these CRD distributions over a 3-year period. Further, the new law allows CRDs to be repaid to the retirement account at any time over a 3-year period. We already discussed that the age for required minimum distributions was increased to age 72 by the Secure Act. However, the CARES Act waived the required minimum distributions for 2020. RMDs that were taken between February 1st of this year and April 15th of this year are eligible to be recontributed back into an IRA prior to July 15th of this year without any tax implications. Distributions prior to February 1st and after May 15th still fall under the normal 60-day rollover rule to be returned back to the IRAs without tax implications. In order to assist taxpayers with cash flow needs, the law allows retirement plan participants, not IRA owners, but retirement plan participants, to borrow up to $100,000 or 100% of their vested account balance from the plan. These limits are now twice as much as they were under the former law. In response to the tuition refunds that colleges and universities are issuing as a result of students having to return home and leave their dorms, the Act also has a provision that such refunds can be recontributed back to a Section 529 college savings plan in order to prevent taxation of the related distributions that were made to pay the expenses. Another change in the Act was the pushback of the various due dates for filing returns, paying balances, and making estimated tax payments. And on this slide, I've listed the various dates for federal, Virginia, and Tennessee returns that have resulted as a result of the COVID pandemic. So here we are now, tax planning. What's my opportunity? First of all, let me say it's never too late to start. It's never too early to start tax planning. Our tax practice is heavy in planning for clients because we understand one basic principle. Nobody likes surprises. Our experience shows that surprises tend to be from a negative standpoint more so than a positive, happy standpoint. Generally, if a client has a bad surprise, it is usually due to the lack of understanding of the impact of financial changes or transactions, or just a lack of communication with us. We look at tax planning as an opportunity to engage the client in meaningful conversation about their business to help them understand their business as well as the impact of their decisions and the effect of those decisions and opportunities upon their income tax bill. We normally begin tax planning during the 9th or 10th month of a client's year. This may seem late, but it gives the client plenty of time to plan any transaction that has to occur before the end of the year and gives them information on their required tax cash flows up to 6 months ahead of time. Often, we will update our projections over the ensuing 1 or 2 months to ensure that the accuracy of the initial projection is good and to help guide the client through the end of the year. As depicted, as shown on this slide here, the first step in tax planning is to determine where you're going to be from a profitability standpoint. This entails starting with the most current data that you have on profitability and adding a layer of projected information for the remainder of the year on top of it. We usually use the prior year profit and loss statement as the basis for the projection period information and make adjustments for known changes in sales and expenses and cash flow to it. It is just as important to understand cash flow as it is to understand your profitability. At the end of the day, we should all be trying to build a business that is profitable and healthy, and the healthier business requires cash and cash flow. After completing your projected profits, you should then prepare scenarios that include the various options that you are considering for the projection period. So consider the various things that you think or that you have been advised may help you from a tax standpoint. think about, do you need equipment? Do you need to pay off debt? Should I pay bonuses to help to myself or to my employees? Do I need tax monies withheld to meet my tax obligations? Should I make a retirement plan contribution? You may consider these items in terms of cash flow, as most of you may not fully understand the tax implications and opportunities associated with each of these items. This is usually a good time to get a CPA or other tax advisor involved to assist you with making these decisions. The decisions that you make should also include consideration of known or anticipated future changes to your business, the business environment, tax changes, and capital requirements. So not only are you thinking about, where am I this year and where am I going this year and what do I need to effectuate this year's tax bill in a positive manner, but you should also think about, what's going to happen next year, what's going on in the economy, what's going on in my business, is my business growing, is it shrinking, am I going to be affected by the need to spend money on a particular item? So, planning includes not only planning for the current year, but usually you think about at least the next year, if not the next several years. Once all the information is accumulated, then you can take your projected profitability for the current year and prepare scenarios for each of your alternatives. For example, a scenario that when we prepare tax projections, we usually start with a scenario that depicts no action, and that is our baseline. So from that baseline, we will then add scenarios that might include the purchase of $100,000 worth of equipment, or let's say we're going to purchase equipment and pay a tax bonus, or maximize retirement contributions. As I mentioned earlier, each of these scenarios should also include a cash flow estimate. Once you come up with these scenarios, they all need to be included with your other items of personal income and deductions to determine what the tax impact is under each scenario, and this will help you in your decision-making process. On the screen now is a sample of one of our tax projections. In this case, the client has made $75,000 so far this year, and he expects to make another $27,500 during the remainder of the year. We have shown basically not only his income, but also his cash flow that we project as of the end of the year. And this projection looks at three different alternatives. One, if he takes no action, it looks like his tax bill is going to be $23,000. And if he maximizes his retirement plan contribution, his tax bill is going to be $13,000. And if he maximizes the retirement contribution and purchases $10,000 of computers, his tax bill is going to be $9,500. So as the lower half of this projection shows, we not only look at his current year tax bill, we try to figure out where he is going with his cash flow through, we generally use April 15th because, that's when balances, any required balance due is required to be paid. And it's also when the first estimated tax payment is generally due. So as you can see in these scenarios, we've given the client enough information to basically see how all his alternatives affect his tax bill and his cash flow. Before finalizing this section on business tax plan, I want to tell you that retirement plan contributions are one of the best tax saving opportunities available, if not the best. When businesses consider the establishment of a retirement plan, they often do so from one of two standpoints. A, either they truly want to offer a benefit to their employees and do not begrudge the employee contribution, or B, they want to get the largest benefit for themselves and their family members as possible with the least cost for their employees. Thus, under either scenario, it's important to evaluate the cost of the contribution in light of the tax savings generated by the contribution, as well as the net cost to the business owner. When you're evaluating retirement contributions, there are many instances where the tax savings associated with the contribution will meet or exceed the contributions paid on behalf of the employee, which makes the contribution more bearable to employers under the second alternative just mentioned, the ones that really only are looking out for themselves and want the least cost possible for employee tax contributions, retirement contributions. You should know that there are several plan options available to employers. Each one has different administrative costs and contribution allocation requirements. The plans are great retirement funding vehicles as their contributions generate tax savings, and the contributions themselves grow tax-free within the plan. The contributions for employees also promote long-term employees, which keeps training costs low. 401k plans have vesting schedule, which require employees to stay with you for up to 6 years in order to fully vest in their contributions. If they leave employment before they are fully vested, any unvested account balances are reallocated to the remaining employees. So as you can see, establishing a retirement plan can assist business owners from both tax and financial planning perspectives. As we move on to tax planning for individuals without businesses, it's important to acknowledge that aside from business income, most sources of income are not controllable by us. That is, we cannot control interest income, dividend income. We can't control when we get our Social Security benefits. Those items of income we cannot control. IRA withdrawals are the one facet of controllable income that individuals have and that we can control at any given time. Currently, taxpayers who rely on IRA income are in a conundrum. Given the current environment, they're assessing their retirement accounts, which are more than likely invested in stocks and bonds, at a time when the market has been negatively impacted. So what they're having to do is sell investments in their IRA during a down market, which prevents the opportunity for the investment to make back any value it's lost, and thus it's truly a loss. Taxpayers who have adequate sources of non-IRA income should consider not taking their RMDs for 2020. If they have already taken their 2019 or 2020 RMDs, they should consider recontributing it back to their IRA. If they haven't taken their 2020 RMD, they may want to instruct their advisor not to issue the RMD for 2020, or at least to wait until later in the year to see if the market rebounds. Also, remember that RMDs now are not required until April 1st of the year following the year you reach 72, not age 70 and a half. So some people may not even have to take one this year. Another effect of not taking an IRA is that it may decrease the amount of taxable Social Security benefits that are taxable this year. There's also a trigger, a class of IRA distributions that retirees over this age of 70 and a half who are making charitable contributions but cannot itemize their deductions should consider, and it's called a qualified charitable distribution. These IRA distributions go directly from their financial advisor to their IRA and thus are not included in their income. So if they're not able to itemize their deductions anyway, by making a charitable distribution, they can effectively reduce their taxable income without having to itemize their deductions. Again, if they reduce their taxable income, they might also decrease the amount of Social Security benefits that are taxable. As we near the end of my presentation, please understand that there's not a lot of magic in tax planning, as it has been legislated out of tax law over the last 34 years. The opportunities for most taxpayers are fairly limited. Businesses have more opportunities than non-business owners. And today I've attempted to provide some information on the most prevalent opportunities. This slide on the screen now includes some of my, what I call tax-related mantras that I find myself repeating to clients year after year. Retirement plans are the first line of defense in tax planning. They allow you to take money out of one pocket and put it in the other pocket and get up to a 45% tax savings as a result. Never spend $1 just to save 45 cents in taxes, because the remaining 55 cents just went out the door. And don't borrow money in order to get an interest deduction. So, again, a lot of just general concepts and on the most prevalent deductions that are utilized anymore in tax planning, as well as the configuration of really how you should go through quantifying your tax planning and the scenarios that you should consider when putting tax planning together. And I'd be glad to happy to answer any questions.
Well, Mike, we do have some questions for you. Number one, can you explain the difference in taxable income as a sole proprietor, an LLC, or partnership?
Okay. Generally speaking, I'm just going to say that they all have the same deductions available to them. A sole proprietor is generally just one person operating a business. They recognize their profits based upon their income minus their deductions. A LLC, if that sole proprietor decides to utilize an LLC to operate within, he's going to have the same income and deductions that are taxable to him and available to him. And ultimately, since he is the sole owner of the LLC, his tax information will be reported on a Schedule C, just as if a sole proprietor's information is presented on Schedule C. So there's really no difference in a sole proprietor from a tax standpoint and a one-member LLC, other than the LLC has a liability veil over it that the sole proprietor does not. If the economic activity is moved into an S corporation, again, the items of income and deduction are going to be relatively the same. And however, for an S corporation, you do have to file a separate tax return, and that tax return generates a K-1 schedule, which just summarizes the profits or losses that are then required to be included on the owner's tax return. At the end of the day, all three entities report their income on an individual tax return in some way, form, or fashion, and that is where it's taxed.
Okay. Can you talk a little bit about the change in deductions?
The specific deductions?
Yes.
I didn't know if is there a specific deduction somebody's interested in, or?
It was related, I think, to the sole proprietor and LLC partnership question above, the taxable income.
Gotcha. Well, really, for 2020, I'm just trying to think, there haven't been any specific changes in deduction other than the changes in depreciation that were provided for in the CARES Act. But otherwise, there are no major changes in anything that is deductible, and I presume you're talking from a business perspective as opposed to an individual perspective. And even so, on an individual perspective, there was an increase in the standard deduction that took effect back in 2018, and that amount is adjusted for inflation from year to year. But otherwise, from an individual standpoint, there really are no major changes in things that are deductible during 2020 from 2019.
And the tax slide that you showed earlier, does that apply also to rental property?
The tax slide. If you're talking about the 20% business deduction, yeah, that's somewhat of a gray area. As long as, first of all, in order to get the 20% business deduction, there has to be business profits. And in regards to rental property, as long as it is an active rental property and not and I'm just going to be very general here, similar to a triple net lease, then yes, the 20% business deduction would apply to that income.
Okay. One last question. Can you tell us the difference for the business owner in offering IRA versus a simple IRA?
Okay. So a business owner, I assume when you talk about business owner, you're talking about a business owner who has employees. And the simple IRA is a very basic type of retirement plan. It is, when I think about retirement plans, I think about various levels, and you walk before you stand, before you run. And the simple retirement plan is a very simplified version of a 401k plan. It allows employees to defer part of their pay into a simple IRA that they establish with a financial advisor. And if they put money into the simple IRA, generally their employer will match whatever they put in, with their employee contribution, up to 3%. So that is the most basic form of retirement plan there is. An IRA generally is not based upon, is not used for business purposes. The IRA is based upon just the individual's income tax return, and that contribution can be elected, it can be made from year to year.
Okay.
The simple IRA, the employer gets a tax deduction for his contributions that he makes for his employees, as well as for the balance that he puts in for himself.
Great. Well, I don't see any other questions. Wait, one more. Does the IRA allow employer to match employee contribution?
The simple IRA does.
Okay.
Simple IRA is very basic. Again, a very basic retirement plan. It's you can basically to adopt the plan. I want to say it's a 2-page form. The employer fills it out, hands the employee out the form where the employee indicates how much of their pay they would like to defer, and it tells the employer who to send the employee contributions to. The employer is required to make the contributions after each payroll period, and generally the form also designates how much the employer is going to match, which generally is, most employers end up matching the same amount as the employee puts in, up to the 3%.
I don't see any other questions. I do, just out of curiosity, what would be the top 3 mistakes or missed opportunities that you see with your clients?
The top 3 missed opportunities, I have to just say planning. And I'll add one more, planning. There's a benefit to knowing where you're going before you get there, and which allows you to maximize any decisions that you have to make during the course of time. So, there are in tax planning, it's possible to do things that save you taxes, but yet maybe you bunch everything up into 1 year. And what you end up doing is saving taxes overall. But if you spread out those deductions, those tax savings may have just affected you at higher income brackets and saved you more tax overall than bunching everything in 1 year and driving your tax bill down to zero. Because we do have a graduated tax system that, that starts at zero and goes up to 37%, and there are various rates in between the two extremes. So the more you drive down your tax bill, it's possible that you are actually diluting the percentage of your tax benefit. So planning your deductions becomes, I think, the biggest thing that clients miss, and it doesn't allow them to maximize their tax saving opportunities.
Super. Now, Mike, I'm assuming you will share your slides and we can get it to those that are joining us today. Wait, one more. Would he recommend all businesses have the Simple IRA for their employees? If so, how much of a tax deduction would the employer receive for doing so?
Right. So again, I think the Simple IRA is a great opportunity for small employers. It gives them the ability to let their employees participate in retirement, and it's very simple. There's not any administration involved with it. There's no cost to the employer, and the employer can put in up to it's $12,000 this year as their contribution. So they would get a deduction for the $12,000 as well as any matching contributions that they made on behalf of their employees.
Sounds great. Well, thanks again, Mike, for doing an outstanding job. Once again, didn't plan anything different. And we will get those, for those that are joining us today, we will get Mike's slides out to you. And I cannot thank you enough for your time and for being part of our new knowledge series, and also for your we're having to make a change now. Where we used to meet in person, now we're doing this on webinar, and hopefully things will change. Just want to put a plug in for our next session, which will be held on June the 3rd. Josh Mancuso with Mancuso Entertainment will be leading a session on motivational leadership, and this will be done on as a webinar as well. But thanks for everybody for joining us, and again, Mike, thanks so much for your time.
You're more than welcome.
I hope everybody has an enjoyable rest of their day. It's a rainy day in the area, but make the most out of it. Have a piece of chocolate or just something to enjoy it. But thanks again, Mike, and thanks everybody for joining us. Have a good day. Bye-bye.